Hi, thank you, Alex. Yeah, I'd like to just say, my main focus when at Nanhua USA is to facilitate trading and investment to the Chinese derivatives markets. Second of all, I'd like to make sure I thank everybody that's going to be on here tonight, the Nanhua research team and TT, and especially the INE exchange for making this whole webinar possible. I believe strongly in the title of tonight's webinar, Opportunities with the Globalized Chinese Crude Oil Options of INE. The key word is opportunities. I will discuss a number of the trading opportunities that I see, and also some comments that I've received from some people that are pursuing and currently trading some of the markets that are involved. Before jumping into that, however, I would like to just give a brief description that, in the international contracts, the 7 international futures contracts and 2 international option on futures contracts that are open to foreign investors of the Chinese contracts. The first, medium sour crude, it started in March of 2018. Iron ore, soon after. TSR 20 rubber came in August of 2018. And then the PTA by the CE exchange came in December of 19. Low sulfur fuel oil, June of 2020. Bonded copper came in November of 2020, and palm oil. The most recent additions have been from the options on futures contracts. Options on the medium sour crude, it happened in June, and also in June, palm oil options became available. Very, very interesting contracts. And as I go forward here now, there's a main reason why a lot of these contracts were picked to be first. If you look on the diagram on the left, you can see the main goods that are imported in China in 2020. Crude oil was the number 2 of everything. Integrated circuits was the first. So crude oil is extremely important to China. As you can see, it's their second biggest import. And also, China is the world's biggest importer of crude. So they have a very, very large need for crude oil. And the purpose of this international contract is twofold. And let me go to the next one. So very, very important. I'd also like to point out is if you look at this list of main goods that are imported by China, you'll also see iron ore, which is another international contract, copper, which is one. You'll see some of the steel products, paper, pulp, soybeans, natural gas. I would suspect potentially that those would be contracts that would be introduced next. But again, very important to keep an eye on the imports of China and why it's important for them to have these contracts. Let me just go back 1 second here first. Actually ready. First of all, there's benchmark crude futures contracts. The NYMEX WTI crude oil has been around for a long time. The ICE Brent crude oil contract has been around for a long time. The newest one, as we mentioned here, is the INE medium sour crude contract. Each contract is somewhat similar in that it has, they represent 1,000 barrels of crude oil. Each one is, priced per barrel. The WTI crude and the Brent crude are priced in dollars. It's there. The advantage that China sees with having their new contract, it's priced in their currency, the RMB. So you can look, these screenshots that I took, they were I clipped them off Bloomberg within a few minutes of each other. You can see there's slight difference in price. The WTI crude oil is at 63.24. The Brent is at 66.02. RMB at 402. That one comes in at just a little bit less than that. If you factor in the, it comes in at 61.86. So a little bit less expensive. A lot of things take place as far as where these delivery points are, supply and demand. All kinds of different factors go into exactly what the price is. Somewhat similar product, but slightly different prices. Creates a lot of opportunity here. Why is there different prices? What's causing that? You might have an edge on what's causing that, or you might have an opinion on what's making that change. So it's very, very important to pay attention to that. And that's one of the main reasons why there's good opportunity in this. As you look at the options on the different contracts, they're somewhat similar. I guess the main thing that I would point out is their American option style. So an American option style options that allows holders to execute their rights at any time before and including the expiration date. So an American option allows investors to capture profit as soon as the commodity moves favorably. So it's important to remember that they're all somewhat similar, but yet represent a slightly different market on there. As you look at all three of them, the correlation of the INE crude, NYMEX, WTI, and ICE Brent is very, very close. Around Friday morning, I made this chart of the current market conditions. You can just see, looking at the chart itself, that the markets look very correlated as far as ups and downs. It does show that slight difference in price, but the actual movement of the markets as far as directional and movement is very similar. If you actually run the correlation study that Bloomberg provides, which is on the left there, you can see that they're very, very close to 1. So a correlation factor of 1 is very, very strong positive correlation. If it happened to have a a factor of toward a -1, it would be a negative, and towards 0 would be no relationship at all. So obviously these are very, very, very strong, and it gives opportunity as far as when I start to talk later about the curve. You remember how correlated these markets really are, and how the rest of the curve should follow in some similar fashion. And we'll discuss more of that a little bit later. Taking another look, again, I'm not on the options so much yet. I'm on the futures, which is the underlying for the options. But this chart represents the volumes. Volumes on, comparison between INE crude, which is in the red, NYMEX, which is in yellow, and the Brent, which is in the blue. You can see the much, much higher volumes, but I would argue that there's a number of reasons why what we see in red is actually pretty good. The Chinese contract has not been around near as long. It's not created as big a following yet. It's not been open as much and has used as much as the other two. So I would expect over time, and we'll talk about where this volume will come from in a minute, but as the futures contract matures, I expect those volumes to grow quite a bit. So now this is where we really start to see some of the opportunities in here. This is actually charts plotting the commodity curve of the different crude oil contracts. On the chart on the left, in the green, is the Brent crude, and the chart and the line in orange is the WTI. You can see those two, curves. Each dot represents a different contract month along the curve. In this chart, I actually chopped off about 4 or 5, almost 5 years worth of the Brent and the crude oil contracts. And as you can see, in white is the INE contract. Not only does it not have the same kind of slope and shape, but it does not have the consistency that it goes along. Again, it creates a number of opportunities. If you just kind of peek at the white line, if you look at the March of 22 is much lower priced than the previous month and the month after. So as these things start to happen, there's different trading strategies, both in the futures and in the options, that you could start to take advantage of those misprices along the whole curve. And as I mentioned earlier in the volumes, as this curve starts to mature, volumes are going to continue to grow all along the curve, and will provide a lot of depth. With that depth, we'll also attract more option trading, because the underlying will be able to be hedged. And so it's kind of the chicken and the egg. It's which one will come first. My argument is that we'll start to see a slow increase in the maturity of the curve, which will attract both futures traders and option traders. Now looking at the INE curve over the last 3 weeks. That's the chart on this page on the right. What I did is I took a snapshot of it on Friday morning, and that was the white line. And then a week ago would be the orange, and 2 weeks ago is the green. You can see the whole curve has shifted lower this last week. But in doing so, there's some inconsistencies along the way. If I were to pull up a chart of the crude, the curve would be much more uniform and have the slope would be much more consistent. This opportunity, as I look at this chart, just sees a great opportunity. The spot month is still highly priced, where the next couple months, next 1, 2, 3, 4 months are actually much lower in price. So I think there's opportunity along that curve that would be able to be taken up with not only the futures trading with different spreads, but as we get farther into it, the option trading will really be able to take advantage, because you'll be able to add a little bit more time to your play. I'd also point out, if you look back at the chart on the right, a normal curve is called a curve in contango, where the spot price is like lower left and it slopes higher as it goes out. But you see right now, the curve that we're in right now with the Brent and the WTI is actually backwardation, meaning that it's higher price now, and as we go further out the curve, it's less price. What's happening there is the prices are high. People are shifting their supplies out to take advantage of it. And if you're an actual person who is, a storage facilities, you're actually going to lose money by storing instead of paying out the curve. So over time, these curves will shift. And at different points, you'll see a curve that is actually lower left to higher on the right, which is completely opposite of what we have. And I might point out again that the INE curve is somewhat flat, and it hasn't started to take shape that way. Although somewhat would argue it could be ahead of the other two curves, and meaning that those other two curves are going to start to flatten out. So depending on your opinion, you can play different strategies to take advantage of that. on this chart, I went and I looked at volume on the futures contracts, just to give an idea. Again, we haven't quite got to all the option information yet, but if you look at this chart, the red and yellow are, oh, I'm sorry, this is the option one. I apologize for this. 1 second, I think I put in the wrong chart. Okay, we are in the options, my fault, guys. The yellow and the red are actually the puts and the calls on the INE, whereas the blue and the pinkish, purplish, or whatever you want to call it, is the puts and calls on the on WTI. So you can see the WTI options have just a lot more volume than the INE options do, but you can also see that the INE options just started in June. So I mean, they're really young in their, in just getting started, and we're starting to see some days where there's some good volumes that are starting to come through, and I'll show you that in a minute as well. So here we can look at it in this chart. This is a screenshot of what is available in the INE options. They both we have an October and a November contracts. I'm showing 15 strike prices in here. You can see that the bids and offers are pretty tight all the way through. They get a little bit wider, but I think over time those are going to, start to tighten up as well. And then also here to the right of this is the call side, but you can see the last 4 days of volume. So there's some days where there's some good volumes in the strikes. Obviously, the calls had more volume lately than the puts. I'm sorry, the calls had less volume. The puts had more volume all the way out through here. So more downside expectations on the puts. Now, in comparison, this next chart is actually one of WTI. You can see each one of these represents a different monthly duration, so different contract: October, November, December, January, February, March. Whereas in this one, you can see that crude oil only offers 2 maturities to trade. In WTI, you can go out, 3 years plus, or almost 4 years, and then they also offer weekly options out 4 weeks. So we have a number of different durations. Again, this comes back to, as the curve matures and there's liquidity in the futures, you'll see a lot more activity start to grow in the options, and I'm sure that you'll see more duration, more contracts offered further out in the duration, and potentially even some weekly options in there. When looking at options, I'm a big fan of looking at implied volatility. As you can see through here in this point, the price is actually coming down and volatility is actually coming down with it. Whereas then all of a sudden at one point, it starts to change and it continues lower, but yet volatility spikes higher. So there's some type of an event that takes place in there. And then from this point on, it almost is an inverse, where when the price starts to trade higher, volatility goes lower. And as price starts to come lower here, volatility goes higher. So different dynamics change. And if you're looking just at futures, you can either be long or short, but as you start factoring in options, the strategies go, you can start playing volatility into your play. And you might think here at these plays, at some point it might come back to this trend, and you can set up an option strategy to take advantage of that. I put this in kind of last minute here today. When you're dealing with options, it's important to understand the Greeks behind them. The delta, the rate of change between the price and the underlying and the price of the underlying contract. Very big, very important to watch. Theta, the rate of change between the option price and time. As you come closer to expiration, that theta starts to increase, where the price will start to take out some of its time decay quite quickly. Gamma, which can get a little difficult, and Vega, which can get a little difficult, but they're so important to watch because they're great ways to add to your strategies. But for Gamma, it's the rate of change between the options delta and the underlying price. So like futures where you're playing long or short, the options, there's many more factors involved. And I think, again, creates great opportunity if you understand your Greeks. That gets me back to this one here, a two-dimensional market versus a three-dimensional and beyond. So if you're playing with a two-dimensional market, I would say it's kind of futures. Some people would argue that there's a little bit more to it because you can have calendar spreads and different types of strategies with futures, but it's pretty much long or short going there. When you start to get into the option plays, many more dimensions added. You start factoring in, like I said before, the Greeks. Not only can you control your risk a little bit more. An example, a bull call spread, which is this little chart up in the upper left. You can set out a strategy to be long a call, short a call, and you're playing this price movement here, and you know exactly how much you paid for it. And at this point, you're not going to make any more money. So your money is made in here. You can do the same thing on the short side, coming down. Then as far as volatility play and movement, you can have straddles, and I didn't put a straddle in here, but a strangle, meaning that the market's going to move, you're just not sure which direction, so you can put on a play either way, being long and short. So I think it provides there. And then you can also get more advanced and do butterfly spreads and option strategies where you're long one, you're short two, and you're long one. So you're looking for the market to stay in between here, and you could take advantage of prices. Now that type of a play, I'm going to swing back here for a minute. If you were looking at the option curve in here, these different things might be a way to put on a type of a butterfly where you'd be long here, short two here, and long one here to play advantage for that curve to be flattened out again. That can be done with both futures and options. Again, options gives you a little bit more flexibility as far as time, but it is a great way to start to take advantage of some of these curve trades. Back here. So also, something else I'd like to mention is now the three-dimensional and beyond. I was actually joined tonight by a client of mine who's interested in. He's a prop trader that's been in the business for a long time, and I was talking to him, and he joined me tonight, and we were discussing the webinar before we got here tonight, before we went on tonight, about the true opportunities. And I think the biggest thing that David mentioned to me is being able to control your risk profile. If you're long or short in the futures, you have to get in and out, but you can set up option strategies that really define where your risk is going to be, and really start to take advantage of some opinions that you have, but also do it in a way that you can very much control how much you're risking. And as options become more and more popular in China, I suspect we're going to see more and more strategy starting to be evolved, and the maturity of both the futures curve and the option curve are going to take advantage of that. So that's kind of all I have to say tonight. I just would say that as you're going through and you're listening to our research department talk about some of the fundamentals with crude oil, and then our representatives from trading technology talking about their platform and how to trade them, is you can start to see how some of these different strategies are implemented, and for sure why they'd be implemented. So with that, I would like to sign it over to our research department and let them take it from here.